Well, great pleasure to join you today. It's in cooperative forums like this that are so necessary for the effective regulation and supervision of our global industry, and to tackle sort of the collective actions and problems that recognize, or rephrase, don't recognize borders, such as climate change, which is really the focus of my comments today. The governments and the regulators of the EU and Asia are both in the vanguard in shaping the global response to the challenges of climate change. And I want to touch on some of these current regulatory issues and provide an industry perspective, much of which has been commented on the panel that's just gone before. But it's worth remembering the scale of the challenge that makes this such a pressing issue for us all. COVID has taught us, I think, above all, that nature-based risks are real, they are existential. The damage and lost lives, impaired livelihoods, and life changes has been so visible and tangible. We're counting the cost for the years to come. The challenge of climate change is never more severe still, and drawn out over time, it's been difficult to capture the urgency politically and in broader society to respond to the challenge that we collectively face. I pay tribute to the regulatory community in having risen to that challenge, the work of the FSB, IOSCO, and the NGFS in driving the agenda forward. In particular, according to the IPCC, there's a finite budget remaining for additional emissions in order to limit average global temperature increases to within a green level. Meeting Paris goals requires emissions to decline from the current annual figure of 53 gigatons by more than 50% by 2030 and net zero by 2050. And the task is not just about reducing emissions. It must be done in a way that creates a just transition. Justice includes the ability of those economically disadvantaged to have some opportunity to catch up with the most fortunate. The transition will require huge investment in rebuilding existing real assets to be more sustainable and creating new assets that will deliver improved prosperity at ever-reducing levels of carbon intensity, reducing to zero. So the challenge is huge, and few places face a greater challenge than Asia, where I'm based. Asia represents more than 50% of the global population and hosts 15 of the 20 global cities most vulnerable to rising sea levels. We've seen the economics and social impacts of climate change and extreme weather events jeopardizing long-term food security, especially in India, China, and Southeast Asia. And Asia is where the largest financing gap exists, where the total regional investment demand estimated at $66 trillion. Meeting this challenge cannot be the task of governments alone. It requires a collaborative approach with the private sector working hand in hand with governments. The role of the finance industry and institutions like HSBC is critical to this. Paris was a watershed moment for many in the industry, including ourselves, and since then we've been on a steep learning curve. In the past, we've made the journey with the regulatory community. HSBC's played a full role in the activities of major regulators, including co-chairing Singapore's Green Finance Industry Task Force that's working with the authorities to develop a green financial center. We were in at the ground floor level in 2016, joining the task force for climate-related disclosures set up by Mike Bloomberg and reporting to the FSB. And the work of the TFSD has been instrumental in helping us think through what good disclosure looks like in sectors most affected by climate, including finance. Last year, we took another step forward, announcing an ambitious new strategy. And that strategy made clear our commitment to net zero in line with the Paris goals. And we aim to reach net zero in our own operations and supply chain by 2030 and across our portfolio by 2050. And this will have a profound impact on our own operations and for our customers through our financing portfolio. But at the heart of what we can do as a bank is what we do for our customers. And the most significant contribution a bank can make is supporting its customers through the decarbonization journey whilst helping to ensure the ongoing resilience and prosperity. To that end, our ambition is to provide up to $1 trillion worth of financing and investment for this purpose over the next 10 years. We must guide our clients as they understand the changes underway and what it might mean for them. and our risk appetite in certain sectors will change. In some cases, that will mean rejecting business that we would otherwise have been prepared to take on in the past. It's important our clients understand that. But it's no in one's interest to have a cliff edge effect in the supply of credit and investments in the broader economy. And it's certainly not in our commercial interest to turn our back on our clients. So our focus is on dialogue, understanding the strategic challenge our clients face, working with them as they consider the transition from their perspective, and being alongside them as they make that journey with all the bumps on the road. For us, that means a huge job of training our frontline managers to have increasingly sophisticated conversations that starts with major corporates, many of whom will have given considerable thoughts to these issues. But the real challenge is extending this dialogue deeper into our portfolio. That process of education is one that we're working hard on as a bank from the board level down and across the industry through our membership of associations throughout the region, such as Hong Kong's Green Finance Association. And our product offering. In addition to dialogue, the most important thing we can do for our customers is increase our portfolio of transition finance solutions to help even the most heavy emitting sectors to progress decarbonization. We have many developments here, from the growing green bond market to more transition related products. We're working with clients to help them develop and present credible transition plans to a market that is rightly focused on how companies are supporting the transition journey. We're deliberately creating solutions across many markets and sectors to incentivize sustainability improvements being demanded by clients. This includes highly bespoke sustainability-linked financing structures with mechanisms based on client metrics and targets for ESG indicators. This covers both public markets and private commercial banking funded and unfunded facilities. We're also working with certification bodies to develop major program-style offerings that provide incentives to smaller and mid-market sized clients in a cost-effective manner. These new products are just one aspect of the change we're seeing. I thought it might be helpful just to mention a few of the developments in the context of the broader market, and I'll concentrate on a couple of these. Firstly, asset management. In asset management, institutional investors have experienced demand for ESG funds for a number of years, but this has increased markedly. And interest in climate change as an investment theme is soaring. HSBC research finds strong inflows into global ESG equity funds during the peak of the COVID-induced crisis in 2020. We find a robust inflow of 38.5% of total assets under management, compared to just 1.3% of inflows into all equity funds globally. And that is a trend continuing well into 2021. Our last major client survey found that investors now cite lower risks or improved returns as their leading reaction for focusing on ESG, ahead of other factors such as it's the right thing to do. And our analysis bears this out. The price performance of global companies with high climate and ESG credentials suggests that sustainable investment themes can lead to outperformance. And Europe and US ESG equity indices have outperformed comparable non-ESG indices over 1, 3, and 5 years. Europe is at the head of this trend. The media attention on climate-related issues has driven a strong focus on climate and environmental-related products for the retail industry. The global pandemic has intensified these environmental concerns, particularly amongst the young. To meet these demands, HSBC, in common with others in the industry, now supplies a range of low carbon funds and ESG sustainable investing solutions. And we're building one of the world's leading natural capital managers to maintain natural capital to mainstream natural capital as an asset class and invest in activities that preserve, protect, and enhance nature over the long term. For this purpose, we've created HSBC Pollination Climate Asset Management. This is just one in-house example of the trend in the industry that we believe now is here to stay. And secondly, sustainable infrastructure. Delivering sustainable infrastructure at scale lies at the heart of the SDGs and the Paris Agreement on climate action. Rapid urbanization, population growth, as well as aging infrastructure networks have led to an infrastructure gap. According to the ADB, $300 billion of funding is required in Asia today, excluding China. And one of the key obstacles for sustainable finance development is not the lack of projects per se, but the lack of bankable projects that are given investment grade status by credit ratings agencies. Currently, there is no way for institutional investors to verify which assets are genuinely sustainable. Transforming sustainable infrastructure into a mainstream liquid asset would help investors make capital allocation choices that support the transition to a sustainable economy. And this is an issue that has been recognized by the authorities too, and there have been helpful steps towards defining what quality infrastructure looks like by the World Bank and by Japan through the G20. And this is a focus at HSBC too. Along with the IFC, the OECD, and others, we're leading a public-private collaboration called FAST Infra, Finance for Accelerating the Sustainable Transition to Infrastructure, that aims to raise private investment in developing world sustainable infrastructure. Central to that initiative is a globally applicable labeling system for infrastructure investments that are sustainable, an infrastructure kite mark, as it were, of sorts. Over 50 global entities representing governments at all levels, the finance sector, investors, DFIs, insurance ratings agencies, and NGOs are now participating in this initiative. Such a label would operate at the level, at the asset level, capturing sustainable issues over the whole life cycle of an asset, planning through to decommissioning. The standards underpinning the label will be broader ESG criteria covering environment, social, governance, and resiliency. The idea is that any host government or developer wanting to ensure that assets are developing is recognized as sustainable could do so by considering addressing these standards. As well as attracting financed individual products, such a label could have wider benefits too. And if I may, I'll skip over the securitization section and move to perhaps regulatory, environmental, and taxonomy issues. So it's clear that the market is responding to the challenge, but none of this can happen to the scale necessary unless we have a legislative and regulatory framework that at least can drive the market. Market players are currently navigating through a range of regimes covering definitions, disclosures, and data. But in such a nascent market, there is an opportunity to avoid some of the transition issues or fragmentation issues that have arisen in other areas. Central to this is the work on definition of what's sustainable and what's not, so-called taxonomies, that many authorities are grappling with. I welcome the role the EU has played with its groundbreaking work on taxonomy. And in Asia too, there's been significant progress in China, Malaysia, and most recently in Singapore. And now ASEAN too is considering a taxonomy that would apply to its member countries. Setting a coherent set of rules of the road, as I believe is necessary, it's the right way to go. So let's say something about the parameters that I think should guide an Asian or an ASEAN taxonomy. The first thing to make clear is that calling for a coherent approach is not about operational costs or simplicity. It's about channeling finance to the countries that need it most. Asia is where the battle to meet climate targets will be won or lost. Secondly, it's not just about harmonization. A coherent approach needs to be flexible to cater for different challenges that economies face at different stages of their development. And thirdly, the taxonomy should not be binary. It must promote the transition to a low carbon economy. The global economy and financial stability would not be served by the cliff edge effects that a black and white approach to sustainability would entail. In addition to these points, we believe ASEAN taxonomy should cover the most important activities and sectors that are key to the transition. It should reference standards adopted in the key financial products and markets that are intermediating and investment and provide investment and credit supply. It should embody existing commitments from ASEAN or agreements where these exist, for example, the ASEAN Green Bond Principles. It should accommodate the nationally defined contribution commitments that ASEAN countries have made under the Paris Agreement. Whenever possible, it should use international standards regarding climate metrics, such as greenhouse gas emissions. But the baseline and the degree of improvement associated with an investment must be tailored to the region's emerging market needs and realities, and that may look different from those used in advanced economies. Finally, as taxonomies come into play, they will need to be matched by the availability of high quality data and disclosure. So I'd argue that the authorities need to consider how data in line with any agreed taxonomy can be made available in those parts of the economy most crucial to the transition. Whether through industry code or regulation, the production of quality data will be central to the ability of a taxonomy to meet its purpose. So in conclusion, the finance industry, like the regulatory community, is on a journey. It's a journey that we need to make together, and I'm most grateful for the outreach that has been enabled to do that. The market is responding, and it has the capacity to drive the transition to a low carbon economy. But it'll only do this to the extent that it operates on the basis of a coherent set of fundamental rules and definitions and channels finance to those parts of the economy that need it most. You're making great progress in putting these rules and definitions in place. So while the need to progress is urgent, I believe the glass is genuinely half full. And I look forward to our future cooperation as we meet this important challenge of our age. Thank you very much, Mark.
Thanks very much, Mukhtar. There is one question, but we're kind of running out of time, so I'm going to skip it. Plus, I think you already kind of answered it around Asia and your comments around ASEAN. I mean, I thought it was a really excellent overview of the challenges around sustainable finance and carbon in particular. If people are obviously more interested in this, in June, we're going to be doing a Sustainable Finance Week of events. Probably Mukhtar might be there speaking. And also on the carbon neutrality bit, our global colleagues at GFMA have done a big piece of work with the Boston Consultancy Group on that. So please take a look at that as well. But Mukhtar, thank you very much. Really, really highly appreciate it. And staying late here in Asia to do this today. So thank you very much.
Mark. Thank you.